This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us today, we have plenty to discuss after some surprising numbers in the September World Agricultural Supply and Demand Estimates report from USDA on Monday. We welcome in and say hello to John Heinberg with Total Farm Marketing. John, good to catch up with you, sir. And what a wild way to come back from a weekend. We expected some volatility from USDA. We usually see it in the September report. And we definitely got it. Surprising drops in soybean yield. Corn yield came down pretty much as expected, but just some very interesting numbers out from USDA on Monday that really impacted the trade, John.
Yeah, very much so. Again, Monday reports are always fun too, because you just don't know how the market's going to feel going into it. We had that strong close on Friday and a little squaring up here on the overnight end of the session today up until that report came out. And we kind of got some numbers again that USDA made some moves. It surprised me a little, I'll be honest. Didn't know how aggressive they would be in some of these yield forecasts. And, at least on the corn side of it, they came down and met those expectations, and beans, they actually surpassed them in this case. So, so with that, we saw a lot of volatility today. Now here we are getting ready for harvest, and you're looking at $14.80 on the bean side, nearly $7 on the corn side. Some really good numbers out there for producers to start working with here as the combine's getting ready to roll.
Well, John, I think a lot of folks thought the soybean number was very surprising, and it was. I want to start with corn, though. Coming down to that pre-report estimate of 172.5. Now, I wasn't necessarily super shocked to see that. It was right in line with the average estimate. I'd like your thoughts on that. Were you surprised that USDA made that big of a cut in the corn yield here, or did you think they would do kind of the traditional route and maybe slow play that number here on the report for September?
Yeah, I'll be honest, I slow played it a little bit in terms of talking with producers and things of that nature, because historically their process kind of goes through that route. But, we do have a little bit of a change in USDA. We saw that back in May when they made that big cut, with the wet planting and dropped 4 bushels the acre off trendline yield back then. And again, the numbers are there. The year count was disappointing. We were really counting on the East and, as well as the Midwest to support what was lost in the West, and it didn't happen. And so it was a reflection of probably the hot temperature still being a factor all throughout the entire early growing season. And then factor in the dryness, obviously, in the western side. So that tightens that corn crop up. Again, too, the markets have priced most of this in. That's why we didn't get much of a reaction with that move last week to get up into the 680 handle. And, realistically, corn was up only, 10, 11, 12 cents at the end of the day today, probably supported by the strong move in the bean market, than anything. So a lot of this is already kind of put in front of us. And, the curious part now is how does the report, or post-report trade go? Sometimes when we get a report that's neutral and the money's already kind of paid into it, we see a little bit of profit taking, especially with harvest right around the corner. So, but again, great value for producers out there. Even despite the drop in yield, the USDA did make some cuts on that demand side. 90 million bushels came off demand. That's something we don't like to see, but obviously they're thinking we're going to be rationing some bushels here, given the tighter supply picture.
Well, yeah, and talk about some of that, some of those demand numbers coming off on the corn side. Production down, obviously. What does this do to the balance sheets in the grand scheme of things here on the corn side, John? Let's talk about that a little bit more, if we can.
Yeah, when we go look at the grand scheme of things again, too, obviously we need to ration supplies here. 1.2 billion bushels of carryover at this time frame is really tight. We said last year we didn't have a lot of wiggle room for a U.S. crop to be off. In this case, here we are again in that exact same situation, if not even a little bit tighter than last year. So, there's going to be a lot of pressure here now in that South American crop to come through to fill those middle areas. And we'll have to watch what happens in terms of their weather, because if we have any hiccups again, any hiccups whatsoever, we can see a lot of volatility in grain prices going forward into the next marketing year. The demand has stayed fairly good at this time frame. So we'll still have to continue to watch, what happens going forward on the weather side, because there's just no wiggle room right now.
Well, as well, John, thinking about where prices stand right now in the corn market, as we talk about that a little bit, 696 December corn at the close on Monday, March 699 and a half, May 699. So we're pretty much right at that $7 mark when we look over at corn on the board. So talk to me, thoughts for farmers here heading into harvest. Is this an opportunity to maybe lock it a floor and move forward from there? I know some folks have maybe talked about re-ownership above, but man, I feel like one bad headline could move this market to the downside. So what's your thoughts with corn and just the marketing thoughts and scheme moving forward?
We got to stay intelligent in terms of where we are in terms of price. And sometimes in these situations, everybody wants to get bulled up. And obviously, there is room to the upside if we do have any hiccups in here. But boy, you're putting some good value in. The thing you need to start looking at is the bigger picture. Like you mentioned, we're a headline away from seeing, prices move one way or another dramatically. So in that regard, we're looking at it here. As prices climb, people want to get more bullish, but we're at $7, and you're going to start putting risk over top of a market that's got a minimized upside, at least historically, where you got a lot more downside room. I'd be kind of looking at make sure if we see value climb, let's think about those bushels you haven't sold yet, and make sure we're building some floor. This is where those puts come into play. Keeps that price flexibility in there, and keeps that upside open if things do fall apart somewhere else in the world, weather-wise, beyond the U.S. harvest, or this crop does get smaller. Let's say we get down to that 170 number. That really puts a pinch on things, or we got a grain stocks report at the end of the month. What if that takes 100 million bushels or 50 million bushels off the stockpile? So again, make sure you're thinking about the bottom side of this thing right now, because again, the global economic situation does concern me going forward. If we do have some issues there, if we do slip into a global recession, or we have issues here in the United States in terms of the economy, you're going to see the money move out of these high-priced assets, and obviously grains are in that boat right now. So, again, as prices climb, make sure you're building the floor under the unsold and look all the way out into next year at the same time. But at the same time, too, use your balance in terms of if you want to keep some upside in. You don't have to own every single bushel. You can have a little bit in just in case we get that move that puts us to another tier. But knowing that, hey, I'm still going to be long the bushels in the field and even next year's crop and that we will be planting.
All right, John, let's talk soybeans. I thought eventually we would get to a 50-ish number on the yield. I didn't think we would get it in the September report, and I don't think anyone did. USDA cutting soybean yield 1.4 bushels an acre down to 50.5. Production cut 153 million bushels to 4.378. Talk about those numbers, John, and just the reaction in the soy complex. I know we had crush cut as well. I mean, we saw meal, bean oil, soybeans just explode to the upside after the report and held there through Monday's trade.
Yeah, that soybean move was, again, something that was a little bit unexpected in that regard. And I mean, the analyst expectations had that range, and that was at the bottom end of that range. So that did get matched in that place. And again, talking to producers here too recently, they've just been kind of saying the bean pods just seem to be missing again. One producer has said what beans he has in them are huge, but there's minimal out there compared to last year. And that's what we saw in their counts today. Pod numbers are down. Maybe, again, reflection of that summertime heat that came across, those key areas. Again, we still had issues in the West, and the East just didn't have enough to outweigh it. So that's what set this market going. And realistically, since those pro farmer numbers came out, and some of those private analyst numbers came out, putting that corn yield down in that 170 handle and keeping bean yields basically unchanged, we saw a lot of spreading in this market. Buy corn, sell beans against it. And I think all that unwound today too. And that was another reason why we saw the big jump in the soybean market. We saw the big jump in the meal and the oil market because that whole bean complex was under pressure. And I misstated earlier, USDA took about 170 million bushels out of corn demand, but they took 90 million bushels out of the bean demand. Now imagine if they would have made those adjustments, where would carryover be? A projection at 200 million bushels is extremely tight. And you talk stocks to use at 4.5%, and we're not even into the harvest window yet. So again, anything that happens with that South American crop, that's going to be an area we need to watch. And there's a lot of explosiveness still left in this bean market. This world's going to be counting on that 150 million metric ton crop coming out of that country in Brazil. And if that doesn't occur, you're going to see some pretty big fireworks as basically the world won't have enough beans to go around.
I was going to say, I think with that 200 million bushel soybean ending stocks, that's roughly a little over a 2-week supply technically. John, that's crazy to think about, really, in the grand scheme.
Yeah, I mean, stock's use of 4.5 times 365 days. That puts us at what, 15 days, 14 days?
Mm-hmm.
Again, that's tight. Pipeline's about 140, 150. So just to kind of tell you how much we need in that regard. So, we're not done. Now, the USDA maybe overshot the bottom side of this. August weather did maintain some of these beans. You saw that in the crop ratings. They were fairly steady through the month of August. So there's still room for them to go ahead and ratchet it up a tenth of a bushel or two. We'll have to see. The other side too in both these was the chop and harvested acres, 600,000 out of the bean side, 1 million acres out of the corn side too. So that was another little wrinkle that, they took some of those FSA numbers and the prevent plant numbers and put them into use, ahead of schedule. Typically they do that in October, but for some reason the numbers are in the right place. So let's get them out there, which I found very impressive too by them. So again, the picture is just tight. We got wiggle room. There's no wiggle room in this market now. If the demand for some reason stays aggressive, again, in these markets, again, they're going to see a supply-driven market turn into a demand-driven market, which could even give us more strength.
So, John, I got to ask, is my thought process with soybeans moving forward kind of the same as the thought process in corn? I mean, looking at the board, solid numbers there on the board after Monday's close. I would have to think that might be a spot to lock in some floors moving into harvest time. What do you think?
Very much so. Again, same mentality. Prices go higher. Make sure you're not forgetting about the downside or backside of this thing. And, again, beans are very vulnerable to selling if we do get some headline pressure. South America will start planting that crop here in the next few weeks. And so that'll be something we'll watch very closely as their weather forecast. Now, unlike corn, this one you probably can still keep a little bit out over top this market because, again, with the range that we can move, you can see things move extremely quickly. And next thing you know, boom, we pop some value in. Again, don't spend a lot on that reownership because you don't want to take a lot from good sales and things of that nature away from you as you move beans here off the combine this fall. But again, you want to make sure you're protected out into the summer, because we've seen bean prices go higher very quickly from these levels. So, there's a case maybe we keep a little safe ownership over top at some premium. But again, don't forget about that floor, because if something does turn negative, whether it's a global economic event or a trade issue with China or more demand concerns in China, the bean prices can roll over very, very quickly, especially when your limit's $1 a day.
John, wheat market after the report out on Monday, didn't feel like there was anything too surprising with the wheat numbers. I know you mentioned to me a few changes globally. Wheat kind of just drifted lower as we went through the day. It felt like. Any thoughts with the wheat numbers and the wheat market action on Monday?
A couple variables in play there. Obviously, we saw some global supplies move up for the next crop year in their forecast, picking up 1.5 million or 1.2 million metric tons over last month. That was probably the thing that weighed on the wheat market, that we still got some supplies out there that can still kind of get through. But again, the available supplies are still extremely tight, and wheat's probably undervalued now compared to both corn and soybeans. So that keeps me a little bit friendly, that market. Unfortunately, it may become the sell against the other two's buys here. So we'll have to watch that. But if corn prices continue to take off and get some more strength to them, that wheat market's going to follow suit, because the demand will pick up on the feed usage side. That was one thing we did see in those corn demand adjustments, was that chop there due to that livestock number being tighter. And again, with those prices where it is, I would expect that feed usage number to possibly shift over into the wheat market a little bit more, especially given where we could be in terms of these values.
John, you mentioned livestock. Let's go there. Hog market a bit mixed on the day. Front months were a little bit lower, but I know you mentioned to me before we went on the air, you're a little more friendly this hog market. So talk about what you are thinking there after we've seen the September WASDE roll through.
Again, we're still thinking longer range in terms of the positioning. With that type of a forecast for grains, in terms of supply available, that's going to keep that any potential of expansion out of that market at this time frame. It's hard to get things put together and make some margins with $7 corn. So that's something I think can support the hog market in the longer term. Obviously, near term, we just continue to struggle with this cash market. I saw midday direct was down another couple dollars today. At least the retail markets found a little stability post Labor Day, so that's going to at least help us. I think that's some of the reason we did see the October maybe trying to etch out a bit of a bottom here, December as well. But again, softer overall today because of that cash market. So, I like the hog market. I think we got to look towards the spring. So maybe there's some value there because, again, we're just not going to see numbers jump up if we're out there trying to feed $7 corn.
Yeah, I couldn't agree more. And I know that cash market in hogs has been struggling as well as you mentioned. So it'll be interesting to see how things go moving forward. Cattle, feeder cattle under pressure, no doubt, from core moving higher, I would think, on Monday. While the live cattle trade held up okay, didn't do a whole lot, but held up okay. So, what's your thoughts in cattle now that we have the September numbers out of the way?
Again, that's a market I really like down the road here in terms of the tighter supply picture. We've seen cash prices kind of fall back last couple of weeks, got us a little bit of a correction. Seasonality was a part of that. Slaughter numbers were pretty strong here. But again, now we're starting to get in that window where some of those tighter placement numbers from later in the spring are going to start showing up. Pasture conditions have kept cow slaughter extremely high. The calf crop will still continue to get tighter. So again, this is something I've been watching here. I think as we move into the end of the year, we're starting to get some footing back under the live cattle markets. 151 out there in December, pushing that 160 number in April, as this market still has good demand under it. Choice carcasses, $2 higher at midday today, still holding that 260 window. That's just a good number out there. Plus this, again, we're looking at the supply of quality beef, higher grading beef in terms of that choice and prime is still tight. And that's going to keep the packers bidding here. So don't be shocked to see that cash market start to get some footing here again as we get closer into the end of the year, which should support this market overall. So to me, we had to get through August expiration. That's past us now. We had to get past the Labor Day window, and now that's past us. So again, it's a window here where I like that live cattle market. I think the feeder cattle market will come back around here too. Obviously, if the corn market continues to climb, that negative inverse just pops right into the market like we saw today in terms of selling on the feeder side. But those supplies aren't there. The cash market on the countryside is still strong for feeders. From talking to my producers, that's something we just want to keep inside because cash still is king. And if the value is there, that's going to keep those feeder cattle supported on the board.
John, you mentioned the outside markets a little bit earlier here in the show as well. And I know on Tuesday we'll have more inflation data out that could be watched in the trade. Dollar moving off its highs a little bit here, but not a ton. Outside market wise, what are some thoughts there as we get into this week that you're really watching?
What's going to happen with that crude oil market? Stock markets had a heck of a bounce back here. Not sure exactly where the momentum's coming from, but it just all of a sudden seems like we had a little break in the U.S. dollar after the European Central Bank kind of lowered it or raised its interest rates. So it kind of made that currency play of sell the euro versus buy the dollar trade kind of unwind. So we'll have to see. But that's brought some money flow into those other markets. A little bit of risk on here at the end last week and even start again today. So there's still some concerns out there. We'll see that inflation data. What's that allow the Fed to do? They can probably still stay after the interest rate hikes, which should keep that dollar tight. That's still going to be the outside factors, the global macroeconomic numbers. That's something that still concerns me regarding all these assets. If we do run into a recessionary type trade again, that's going to be that trigger that could send some of these prices lower, regardless of where they are. Because you look at historically, right now we're high priced on cattle, on grains, and if funds need to take some money off the table, that's the area that they'll attack.
Well, John, as well, I think everyone in agriculture and a lot of other sectors is watching this rail issue here. If they don't get an agreement by Friday, we're talking lockout, we're talking, a railroad strike, a slowdown. And if something like that were to happen here heading into harvest, I know we're hypothesizing a little bit, but I can't imagine that would be good for agriculture as a whole. And I would have to think it would have an impact on the markets if we were to see some sort of strike or lockout from the major railroads here in the U.S.
That's a concerning point to me right now, too, is just keeping an eye on that and the news headlines that are going to be going there. That's going to really have an impact probably in the cash market side. If we start backing up those supplies, obviously that'll impact the basis and those things in terms of the cash market, especially at a window when the supplies should start growing here as the combines get rolling. So definitely a key piece of this puzzle. Again, to me, the biggest risk out there for these grain markets is not so much the numbers in front of us in terms of production. It's all those outside factors, rail strike, economy, anything like that can cause the funds to want to pull the trigger, take profits. Again, that's why as prices go higher, make sure you're still kind of building some base underneath there to protect these values, this year as well into next year as well.
Well, John, always appreciate the insight. I know we're up against the clock. If folks want to reach out to you and get some advice and work through their marketing plan, I know they could do that. Total Farm Marketing is, you guys have a lot of great ways to get in touch with you. How can people get a hold of you guys?
Sure, love chat with anybody anytime. Feel free to give me a call, 800-334-9779. Shoot me an email, jonh@totalfarmmarketing.com. Again, don't forget about our website, totalfarmmarketing.com. A lot of great information for producers out there. Again, stay on top of things, especially as you get busy with the harvest window. And don't forget about the key side of it here again with the markets.
TotalFarmMarketing.com is a great way to start. With that, John Heinberg, always appreciate the time and insights, sir. Have a fantastic rest of your week, and we'll talk to you again next week.
Sounds good. Have a great week.
John Heinberg with Total Farm Marketing. That's going to do it for today's Market Talk. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.